Meet Ryan and Alex. They're both 34 years old. They both live in Austin, Texas. They both earn $95,000 a year before tax. They both have $120,000 sitting in investments after years of saving. And they both have exactly the same goal: turn one great investment into life-changing wealth. Ryan decides to buy shares in SpaceX the moment he gets the opportunity. He doesn't care if it's through a private market, a special purpose fund, or a future public listing. His logic is simple. It's SpaceX, the company launching rockets, building Starlink, winning government contracts, and talking about Mars. If any company could become the next trillion-dollar giant, surely it's this one. Alex makes a completely different decision. Instead of chasing a single private company, he builds a diversified portfolio of low-cost, stock index funds and keeps adding £1,500 every month. Ask either of them who's making the smarter choice, and you'll get two very confident answers. Ryan thinks Alex is settling for average. Alex thinks Ryan is gambling. Here's the strange part. They're both wrong, because the biggest mistake isn't buying SpaceX stock, and it isn't avoiding it either. The real mistake is assuming you already know what the numbers say before you actually run them. By the end of this comparison, one tiny assumption changes their long-term wealth by hundreds of thousands of pounds. And it's probably not the assumption you're thinking about. To make this completely fair, we're giving both of them identical starting conditions. Same age, same salary, same city, same investment balance, same monthly savings. The only difference is what they do with their money from this point forward. Because feelings and maths are two very different things. Ryan's opportunity arrives through a private investment vehicle that offers exposure to SpaceX shares. He invests his entire £120,000. Now here's where reality starts creeping in. Unlike buying a normal public stock, private investments often come with additional costs. Some secondary market platforms charge transaction fees. Certain investment funds charge annual management fees that commonly range between 1% and 2%. Some also charge performance fees if returns exceed certain thresholds. Ryan isn't thinking about any of that. He's thinking about headlines, record launches, Starlink subscribers, NASA contracts, videos of rockets landing upright. Every news story feels like confirmation that he made the right choice. Alex's investment couldn't look more boring. He buys a globally diversified equity index fund with an annual expense ratio of around 0.05%. His £120,000 goes to work immediately across thousands of publicly traded companies. Every month he automatically invests another £1,500. Nobody asks him about it at parties. Nobody sends him exciting news articles. Nobody tells him he's investing in the future of humanity. It's just numbers quietly compounding in the background. One investment gives you stories. The other gives you statements. Most people naturally prefer the stories. Now let's look at what actually happens. After the first year, suppose SpaceX performs exceptionally well. Let's assume Ryan's investment grows by 25%. His £120,000 becomes £150,000. That sounds incredible. On paper, that's a £30,000 gain. Sounds great until you subtract everything else. Suppose his investment vehicle charges a 2% annual management fee. That's about £3,000. If he entered through a platform with a 3% transaction fee, another £3,600 disappeared on day one. If the fund eventually applies a performance fee, that's another layer waiting later. His headline return says plus 25%. His actual economic return is already lower. Alex doesn't get exciting returns. Let's assume the global stock market delivers a more ordinary 10% year. His original £120,000 becomes £132,000. His monthly investments add another £18,000 during the year. Ignoring market timing for simplicity, his account finishes close to £151,000. Wait a second. Ryan had the exciting investment. Alex had the boring one. Yet after only 1 year, they're sitting surprisingly close together. Ryan feels like he's crushing the market because every headline talks about SpaceX's valuation. Alex barely checks his account. Emotionally, Ryan wins by a mile. Mathematically, not nearly as much. And this is where investors start making dangerous assumptions. They see a company growing rapidly. Then they assume the investment automatically produces extraordinary returns. Those aren't the same thing. A fantastic company can still become a disappointing investment if you pay too much. History is full of examples. Some of the greatest businesses ever built spent years delivering mediocre investor returns. simply because expectations became too high before investors bought in. Private companies create another complication. You don't always know exactly what price you're paying. Public markets continuously discover prices every trading day. Private markets don't. Instead, valuations often come from funding rounds, negotiated transactions, or specialized secondary markets where liquidity can be limited. That matters more than most people realize. Imagine buying the world's greatest house. If you pay twice what it's worth, you've created a problem before you even receive the keys. Investing works the same way. The business can be spectacular. The investment can still disappoint. Meanwhile, Ryan starts noticing another hidden cost nobody warned him about. Liquidity. If he suddenly needs cash, selling isn't as simple as clicking a button during market hours. Depending on how he owns the investment, buyers may be limited. Transactions may take weeks or even months. Some structures have lockup periods. Others only process redemptions at specific intervals. Alex doesn't have that issue. His index fund can generally be sold on any trading day. That flexibility has value. It's difficult to assign a number to until the day you actually need it. On day one, Ryan thought he was buying unlimited upside. On day one, Alex thought he was sacrificing excitement for stability. Neither of them realized they were also buying completely different levels of flexibility, cost, and risk. And the biggest surprise hasn't even happened yet. Because over the next few years, one number quietly starts working against Ryan, while another starts working in Alex's favor. Almost nobody notices either one, until the gap becomes impossible to ignore. Year 3 arrives, and the headlines surrounding SpaceX are even louder. Starlink continues adding customers. The company wins additional launch contracts. Analysts speculate about future revenue from satellite internet, defense work, and eventually Starship. Every funding round seems to assign an even higher valuation. Ryan feels brilliant. His original £120,000 investment is now valued at roughly £210,000 after another strong round of private market appreciation. On paper, he's up £90,000. Sounds incredible. On paper, that's a £90,000 gain. Sounds great until you subtract everything else. His investment vehicle has continued charging a 2% annual management fee. Over 3 years, those fees have quietly added up to roughly £11,000, depending on the account value throughout the period. If the fund also charges a 20% performance fee above a benchmark, another portion of his gains may never actually belong to him. And here's the number almost nobody brags about. Ryan still hasn't realized any profit. His account statement says £210,000. His bank account says 0. The gain exists on paper, but turning it into spendable money depends on finding a buyer at that valuation. Private investing isn't just about what your shares are supposedly worth. It's about whether someone else is willing and able to pay that price. Alex's portfolio couldn't be more different. Global markets haven't been exciting every year. One year returned 18%. Another returned only 3%. One even declined by 11%. But he kept buying every single month. His £120,000 starting balance, combined with £54,000 of monthly contributions over 3 years, has grown to approximately £208,000, assuming an average annual return close to 10%. Notice something interesting. Ryan's exciting investment sits around £210,000. Alex's boring portfolio sits around £208,000. The gap is almost nothing. Yet if you asked either investor how they felt, you'd think one had won the lottery while the other had settled for mediocrity. That's the strange power of narrative. People remember rocket launches. They don't remember automatic monthly investments. People remember billion-dollar funding rounds. They don't remember low expense ratios. Feelings and maths are still telling completely different stories. Now let's move to year 5. This is where investing becomes less about headlines and more about behavior. Suppose SpaceX continues performing well. Ryan's investment reaches approximately £300,000, a fantastic outcome, nearly 2.5 times his starting investment. Financial media can't stop talking about it. Friends start asking him how they can get in. Suddenly everyone wishes they'd bought earlier. But another question quietly appears. How concentrated is Ryan's wealth? The answer is almost all of it. Nearly everything depends on one company, one management team, one valuation, one future IPO. Successful execution of ambitious long-term projects. If anything unexpected happens, his financial future moves with it. Alex's situation feels far less dramatic. His portfolio has now benefited from 5 years of consistent investing. His original investment has compounded. His monthly £1,500 contributions have continued without interruption. His account is now worth roughly £310,000. For the first time, the boring strategy quietly moves ahead, not because it produced spectacular annual returns, not because Alex discovered a secret investment, because he kept adding money while thousands of businesses around the world kept earning profits. This is the flip point. It doesn't happen because Ryan loses money. It happens because Alex never stopped compounding. Ryan's investment depends heavily on valuation growth. Alex's wealth depends on ownership growth. Those aren't the same thing. Now imagine something completely realistic. SpaceX delays a major program, a launch failure temporarily slows investor enthusiasm, or broader interest rates rise, causing private company valuations across the technology sector to decline by 25%. Has SpaceX suddenly become a bad company? No. Has its long-term future necessarily changed? Not at all. But private market prices don't move in straight lines. Suppose Ryan's £300,000 valuation temporarily falls 20%. His statement now shows £240,000. He's still ahead overall. But psychologically, losing £60,000 on paper feels very different from never having gained it. Alex experiences market declines too. His globally diversified portfolio might fall 15% during a bear market. His £310,000 account temporarily drops to around £264,000. The difference is what happens next. Alex keeps buying every month. Lower prices mean each new contribution purchases more shares. Ryan doesn't necessarily have that opportunity. His ability to buy additional SpaceX shares depends entirely on whether another private offering becomes available, and at what valuation. That's a variable he doesn't control. And this brings us to something almost nobody talks about when discussing private companies: price discovery. Every publicly traded company is constantly being valued by millions of buyers and sellers. Private companies aren't. Sometimes months pass between funding rounds, sometimes years. That means the number on Ryan's statement isn't being tested every day by the market. It's an estimate based on the latest transaction. It may be accurate. It may also change dramatically the next time investors negotiate a new valuation. Neither outcome is guaranteed. Now let's talk about the one number everyone loves to post online: the company's valuation. You'll hear someone say SpaceX is worth hundreds of billions of pounds, and immediately people assume buying shares guarantees similar wealth creation. But valuation isn't cash. Valuation isn't profit, and valuation certainly isn't your personal investment return. What nobody talks about are the hidden layers underneath that headline number. First, access costs. Most investors can't simply open a brokerage account and buy SpaceX shares. Many gain exposure through private funds that charge annual management fees between 1% and 2%, sometimes alongside performance fees. Those costs reduce returns every single year. Second, liquidity. Unlike publicly traded shares, private investments can be difficult to sell quickly. You might wait weeks, months, or longer, depending on market conditions and fund rules. Flexibility has value, even though it rarely appears in performance charts. Third, valuation risk. Private company prices often depend on the latest funding round rather than continuous market trading. A single financing event can dramatically change the reported value of existing shares. Fourth, concentration risk. Ryan owns one extraordinary company. Alex owns thousands of companies across multiple industries and countries. One bet versus an entire global economy. Neither approach is automatically right, but they carry very different risk profiles. Fifth, opportunity cost. Every pound tied up in one private investment is a pound that can't easily be reallocated elsewhere if better opportunities appear. That cost doesn't show up on any account statement, but over decades it can become surprisingly expensive. By year 5, Ryan still believes he made the smarter decision because he's to be invested in one of the world's most exciting businesses. Alex believes he made the smarter decision because his wealth keeps growing without needing perfect predictions. They're both focusing on different numbers, and in the next stage, we'll discover which numbers actually matter when taxes, an eventual IPO, and long-term compounding all collide. Year 10 changes everything. Not because SpaceX suddenly fails, not because index funds suddenly become exciting, but because time has a habit of exposing every assumption investors made at the beginning. Let's give Ryan the outcome he was hoping for. After years of speculation, SpaceX finally becomes publicly traded. Investor demand is enormous. The shares open well above the last private valuation. Ryan's investment, after all those years, is now worth approximately £520,000. From the outside, it looks like a perfect investment. Friends congratulate him. Social media is filled with screenshots. Financial news calls it one of the greatest IPOs in decades. On paper, Ryan has turned £120,000 into more than £500,000. Sounds incredible. On paper, that's a gain of roughly £400,000. Sounds great until you subtract everything else. If Ryan invested through a private fund with annual management fees over 10 years, those fees may have totaled £40,000 to £70,000, depending on the fund structure and portfolio value. If performance fees apply, another percentage of the gain disappears. Then comes capital gains tax. The exact amount depends on where Ryan lives, how the investment was structured, and his personal tax situation. The headline number isn't the number he keeps. It's the number he starts with. Now let's check on Alex. He didn't own the hottest company in the world. He owned thousands of businesses. Some failed completely. Some doubled. Some became global giants. Others quietly disappeared. He didn't need to predict which ones would win. His globally diversified portfolio continued returning roughly 10% annually over the decade, while he consistently invested £1,500 every month. After 10 years, his account is worth approximately £690,000. Read that again. Ryan owned one of the most exciting companies ever created. Alex owned almost everything, and Alex is now ahead. Not because SpaceX was a bad investment, because he combined compounding with continuous investing. People love comparing investment returns. Very few compare investment behavior. Behavior often wins. Now here's where the conversation usually becomes dishonest. If I only showed you the downsides of buying SpaceX, I'd be doing exactly what many anti-stock commentators do. That's not useful. So let's steelman Ryan's decision. There are absolutely situations where buying SpaceX could outperform everything Alex did. Imagine SpaceX grows far beyond today's expectations. Suppose Starlink becomes one of the world's dominant internet providers. Suppose Starship dramatically reduces launch costs and opens entirely new commercial and markets. Suppose the company successfully expands into businesses investors haven't even imagined yet. In that world, Ryan's investment might be worth £1 million or more, instead of £520,000. Concentrated investments can create extraordinary wealth. History proves that. Early investors in companies like Amazon or Nvidia experienced returns diversified they portfolios simply couldn't match. But here's the other side. Very few companies actually become Amazon. Even fewer become Amazon after you've already bought them at a high valuation. A wonderful business doesn't guarantee wonderful returns. The price you pay still matters. Now let's also be fair to Alex. Diversification has downsides. His portfolio experienced multiple bear markets. At one point, his account temporarily fell more than 30%. Watching hundreds of thousands of pounds disappear, even temporarily, is emotionally difficult. Diversification also limits maximum upside. Alex will probably never wake up to discover one holding increased 500% overnight. Average returns feel boring, sometimes painfully boring, until decades pass. There are also situations where Ryan's strategy clearly wins. If someone has exceptional knowledge of the aerospace industry, if they can access SpaceX shares at a significantly lower valuation than institutional investors, if they already have a diversified portfolio elsewhere and only allocate a small percentage to SpaceX, or if SpaceX's future businesses dramatically exceed today's expectations, concentrated investing can absolutely outperform. The key isn't that Ryan chose SpaceX. The key is whether he understood the risks before making that choice. Now let's ground this in real data. According to historical data published by the S&P Dow Jones Indices, the vast majority of actively managed U.S. equity funds have underperformed the S&P 500 over long time periods after fees. According to the U.S. Securities and Exchange Commission, private securities are generally less liquid than publicly traded investments and may be more difficult to value accurately. And according to SpaceX's publicly reported business updates and contracts, the company has secured significant commercial launch revenue, government contracts, and continued expansion of its Starlink satellite network. Those are facts. None of them guarantee future investment returns. Now imagine one simple change. Instead of investing £1,500 every month, Alex increases his monthly contribution by just £200. That's £1,700 instead. Over 20 years, Assuming similar long-term market returns, that seemingly small adjustment alone could add well over £150,000 to his final portfolio. Not because he found a better investment, because he invested more consistently. Small monthly decisions become enormous long-term differences. If you're considering buying SpaceX stock whenever it becomes available, here's a practical framework. Step 1. Figure out exactly how you're getting exposure. Is it direct ownership, a private investment fund, a special purpose vehicle? Each comes with different fees, liquidity rules, and tax consequences. Step 2. Calculate your total costs before looking at potential returns. Entry fees, annual management fees, performance fees, taxes. Estimate every one of them, because every pound paid in fees is a pound that never compounds. Step 3. Decide how much of your total net worth belongs in one company. Not based on excitement, based on risk. For many investors, concentrating 5 to 10% of an overall portfolio in a single, high-conviction idea feels very different from betting everything. Now let's zoom all the way out. 20 years later, Ryan's investment, assuming excellent execution by SpaceX and a successful public market journey, may have grown into somewhere between £900,000 and £1, £2 million after significant appreciation. That's an outstanding result. Alex's diversified portfolio, with 20 years of disciplined investing and average market returns, could realistically reach between £1, £3 million, and £1, £6 million. Neither outcome is guaranteed. Both depend on future market performance. But one relied heavily on predicting a single winner. The other relied on the global economy continuing to grow over decades. Now think back to the beginning. Ryan walked away convinced he had invested in the future. Alex walked away convinced he had avoided unnecessary risk. Neither of them actually ran every number. Ryan underestimated fees, liquidity, valuation risk, taxes, and concentration. Alex underestimated how much a truly exceptional company can outperform if everything goes right. The real trap was never buying SpaceX. The real trap was never avoiding SpaceX. The real trap was making a decision based on hype, headlines, or someone else's opinion, instead of running the numbers for your own situation. Because the smartest investment isn't always the one everyone is talking about. It's the one that still makes sense after you've included every cost, every risk, every tax, every fee, and every realistic outcome. If you're wondering what happens when you combine both strategies, building a diversified portfolio while allocating a small percentage to high-conviction companies like SpaceX, that's a completely different conversation. And it might be the most interesting one yet. So before you make your next investment decision, ask yourself one simple question. Did you include everything? Because the answer that includes everything is the only answer that matters. If this video helped you see something you didn't know was there, subscribe to Wealth Blueprint and hit the notification bell. We break down the hidden maths behind the financial decisions you face every day.